What's up everyone, Dan again, Stocktrades.ca. First off, I'd like to apologize for the lack of videos as of late. We've had to focus primarily on our premium end over the last few weeks with the market crashing at the speed it has been. We've had a lot of members and just general website visitors who are at an absolute loss at what they should do right now. I decided to make this video to highlight some industries that I feel will really struggle because of the COVID-19 outbreak, and some industries that I feel that every investor should either own right now or consider owning moving forward. These are primarily defensive stocks that have held up quite well considering the current economic conditions. I've also had a ton of emails and questions on how I feel about the spread of the virus. I'm not a doctor, I'm not going to pretend to be. The only aspects I'm going to talk about in terms of COVID-19 are how it's going to affect your investments moving forward. So let's kick this video off with a general recap of what has happened over the last 2 weeks, my opinion on what is going to happen moving forward, and then we're going to get into some industries I feel are going to struggle and some that are going to thrive, along with some individual stocks that you should be looking at today. So what is actually happening right now? If you're a current investor, someone who's thinking about investing, or somebody who's just been sitting on the sidelines, you've actually just witnessed history. This is the quickest stock market crash we've ever seen. The markets down south entered bear market territory in as little as 19 days, and this has never been seen before, never even close. And if we look at the TSX, a little over a month ago, the index traded around 17,800 points. As we look right now, the index trades just over 12,000. This is a decline of over 32% in a little over a month. If we look back at the sharpest declines, the fastest declines of the indexes, and compare now to the financial crisis, on September 12th, 2008, the TSX traded around 12,700 points. If we look to just a little over 1 month later, the index traded around 9,200 points, which would be a decline of around 27.2%. The markets in the USA last week saw the largest amount of volatility they've seen since the Great Depression, almost 100 years ago. And the TSX managed to post its worst single-day loss since the Second World War. But unless you've been living under a rock the last few weeks, you know how bad it is. I'm not going to waste your time and mine speaking about it anymore. I'm just going to move forward with a question that I probably get in my inbox now 50, 60 times a day, and that is, should I sell my stocks, and should I be looking at buying stocks right now? Now, the first and easily the most frequent question that I'm getting right now is, should you sell your stocks? And my answer to this is, if you did so a month ago, you would probably look like a genius. A lot of people would say you got lucky. I would tend to agree. We did not know it was going to get this bad. But selling your stocks right now, after the index has already fallen 30%, you're a little late to the party, and this is unfortunately why the large majority of investors who try to go on their own lose money. They've been buying on this 10-year bull run, and they're finally going to dump it all after we've wiped out 4 years worth of gains in a little under a month. Ultimately, they'll lose a large portion of their money right now and try to time the market on the upswing again. They'll probably make some huge mistakes, and in the end, they will end up in a perpetual cycle of continuously losing money. And this is a fact. It happens all the time. My personal opinion, stay invested. It's the only thing you can do. If you own strong stocks right now, you should have absolutely nothing to fear. If you've done your research and you've bought into reliable companies that have the cash, that have the low debt to equity ratios that can survive a situation like this, then you have absolutely nothing to fear. The markets will come back. They always have come back. But if you own speculative stocks right now, ones that don't pay dividends, ones that hold a lot of debt, and ones that are not in a position to financially weather this storm, then you might be in a bit of trouble. But your portfolio should not be heavily allocated towards these stocks. And if it is, this is a very strong lesson learned that you need to be investing in more reliable companies and overall sacrifice higher gains for more safety. Our next question, should you be buying stocks? And I want to speak on this in 2 ways. First off, the type of stocks you should be buying if you're going to consider buying right now. And secondly, how you should go about buying them. Right now, I would strongly suggest avoiding any pure growth play right now. We've seen stocks like Tesla lose half their stock price in a little over a month. Stocks like Shopify plummet. These companies that don't pay a dividend often get sold first because there's no benefit to owning them right now. If you're going to be looking at buying stocks right now, I would heavily suggest looking at defensive options only. Ones that are going to benefit from the current interest rate drops we're seeing, and also ones that will continue to see strong revenues in the current economic conditions. Now, if you are going to be buying these stocks, it is very important you do something that we like to preach, and that is averaging into a position. This is absolutely critical. Even before, when the market was at all-time highs, we still suggested taking half position and filling that position after a predetermined amount of time by you. So quickly, what is averaging into a position? It's a pretty easy concept. If you have $10,000 that you want to invest into a stock, a half position would be considered buying $5,000 now and filling that position at a later date. When the markets were at all-time highs, we suggested taking half positions to avoid volatility. And if you look at the volatility that is happening right now, we would suggest taking that even further. If you're going to be purchasing stocks right now, even ones that are defensive in nature, the ones we're going to talk about in a couple minutes here, we would heavily suggest even going as far as to taking a quarter position, buying a quarter now and filling it as you move forward. That could be a quarter in the next 2 weeks. That could be a quarter a month later, filling your position over the course of 4 months. The one thing you do not want to do right now is to take $10,000 and dump it into a single stock on a single day. Before all of this, a 1% move in the TSX would have been considered extremely rare. Right now we're seeing 5% moves in either direction on the daily, and you do not want to get caught up in this. Now, two industries I really feel are going to struggle from this are obviously airlines and oil and gas. I mean, in terms of airlines, they've shut down the borders. Just this morning, they shut down the borders to the USA. Airlines are essentially going to be at a complete halt. WestJet just recently laid off over half of their employees, and I would largely expect Air Canada to do the same. Now, in terms of airlines, I would expect the government to help them out. I mean, we really only have two major airline players here, WestJet and Air Canada. And if one of them were to go bankrupt, you essentially have one major airline controlling the whole country. The next industry, oil and gas, they have been hit by two massive blows right now. One of them being the pricing war in the east between Russia and Saudi Arabia, and the other being the COVID-19 crisis, which has absolutely collapsed the demand for oil. We've seen WTI crude fall from the $60 range to under $28 a barrel. Now, oil and gas players, I'm long Suncor and Canadian Natural. It is absolutely imperative during times like this that you own companies that are able to withstand this type of bear market, and those are two that I feel can. But like I said previously, if you're investing in speculative oil companies with borderline dividends, I mean, we've seen a ton of dividend cuts down in the States from oil and gas companies, and I would expect these players to cut their dividend as well. It is actually even possible we could see dividend cuts from the major players, but some of these companies are still borderline cash positive at these oil prices, so they may be able to survive it. But the situation with COVID-19 will have to be resolved fairly quickly, because the longer this goes on and the more downside pressure that is put on the price of oil, the financial impacts could be a lot worse. And let's move on to some industries that I believe may do well. And keep in mind, when I say do well, I essentially mean outperform the market in terms of losses. You're not going to see much gaining right now, but it's important that you have defensive options within your portfolio to reduce your overall losses and reduce your overall risk tolerance. First stock I'm going to speak on, and one that is deemed one of the most reliable companies in the country, that is Fortis. They trade under the ticker FTS. Now, as of me filming this right now, the market has shed nearly 30%. Meanwhile, Fortis has lost around 17%. I mean, this is quite a significant amount. The reasoning for this is actually quite a few things. For one, as the Bank of Canada continues to drop rates, utility companies are in a position where they can borrow money to expand infrastructure for much cheaper. Secondly, Fortis has a dividend streak of over 46 years. This means that they have raised dividends through the stock market crash of 1987, through the dot-com bubble in 2000, through the financial crisis in 2008. Investors are confident that they will continue to do so even through this. This has a dual effect. This means that investors holding on to Fortis aren't selling their shares right now, and investors who are looking to take a more defensive approach and buy companies on the cheap are buying Fortis right now just because of its reliability. And with over 3 million customers, 99% of Fortis's revenues are from regulated utilities. People need power, they need electricity. That's going to be one of the last things they shut off. And as such, we can expect Fortis to perform better than most during an economic downturn. Now, the next stock I'm going to talk about is probably one you know about already, probably for the wrong reasons though, and that is Loblaws. People are hoarding groceries right now at a level that I deem to be completely unnecessary, and as such, Loblaw's stock has actually only fallen 2% through all of this. The TSX has lost over 30% as I'm filming this video, and Loblaw's has barely dipped in price. But it's important to note that I am not suggesting this stock because people are mass hoarding groceries. I'm suggesting this stock because even during an economic downturn, people need to buy groceries. It's a well-known fact that these types of consumer defensive companies perform better in economic downturns. We might see a surge in its first quarter and even second quarter earnings reports if the hoarding continues. But overall, the real strength of companies like this is over an economic recession, people still go to these stores and still purchase groceries. And as I can note again, Loblaws does pay a dividend. Their yield isn't out of this world. It's only around 2% right now. But the key thing is the dividend only makes up around 18% of free cash flows. Having the dividend only make up 18% of free cash flows means it is extremely safe during times like this. The third and final stock that I'm going to speak about is CN Rail. In terms of losses, CNR has lost 20%, which is significantly lower than the benchmark index, the TSX, which, as I've said, has lost over 30% at the time of filming this video. And the number one reason we would suggest owning CN Rail right now is the fact that they have such a wide economic moat. And by this we mean that there is very little competition in the country for somebody to come in and scoop up market share. And although we can expect revenues from the railway to decline, vital goods are still going to need to be shipped around the country regardless of the economic conditions. Now again, CN Rail's price has more than likely been saved from a more drastic fall due to its dividend. The company has increased dividends for 24 straight years. This means that, again, they increased dividends through the last two crashes we've seen in 2000 and 2008, and the company's dividend only makes up around 25% of operating cash flows. Now, the yield is fairly small. It's a little bit higher than Loblaw's, but it is at 2.19%, and the company has been growing their dividend at a pretty rapid pace as of late. Now, I would expect that to slow down. We might see companies delay dividend increases during these hard times. Wrapping this all up, if you have a ton of cash right now, it's easy to see why you're excited at this opportunity. The market hasn't been this low for 4 years, and even during that 4-year time, it touched these levels very briefly. But I have watched people buy the dip, even going back as little as February when the markets had barely been touched. And we haven't even touched the surface of the economic impacts of COVID-19 on the economy here in Canada, in the United States, and around the world. Dollar cost averaging is a sound strategy. In my opinion, if you're doing it, continue to do it. That being said, there is a lot of income plays right now that are providing strong value. And those are the stocks we would suggest looking at, like CN Rail, like Fortis, like Loblaws. But for those looking to try and time the bottom and get in on some high potential growth plays, you are probably taking on substantially more risk than you truly know you are. And until we see a little bit of stabilization, I would not recommend it at all. That's pretty much it for this video. If you liked it, head down below, like the video, hit that notification bell, subscribe to the channel. We've also got a link down below in the description to our premium end. We've helped a ton of investors, new and experienced, navigate what is going on right now. And if you do want to join us, there's a discount below. Till next time.